So, you know, as the startups right now in fashion, all over the world, even in Pakistan, India, USA, China, startups are in fashion. So when a newly starting people, they don't have source of finance, so they generate from investors, right? They sometimes go for crowdfunding, that a common man can invest in them. So there are different types of how. Now the question is how to record that crowdfunding, because when you receive funds, you have to debit bank. I repeat, whenever you receive any funds from any person, you will debit your bank. Now the question is what you will credit. You have option to credit equity, yes. You have option to credit liability, yes. You have option to credit P&L, yes. And you can also credit deferred income. So there are many options. There are many options. This thing is clear that initially you need to debit the bank. Credit side, there are multiple possibilities. On the credit side, there are multiple possibilities. Okay. So students, look at here. These are the some basic definitions. Even in my last session revision days, I discussed this. Read it. Some are equity-based crowdfunding. The equity-based approach is targeted at investors who receive shares. Obviously, we give the residue interest in the assets to those people, right? Or we can say we gave them voting rights type thing. Now, debt-based crowdfunding. With debt-based crowdfunding, a contributor makes a loan to a business that's looking to crowdfund with the intention of subsequently being repaid with interest. Yes, if somebody is giving us money with the intention of getting fixed return, so again, this thing is it's a loan, right? Now, the third point is reward-based crowdfunding. Reward-based crowdfunding. For example, I launch a new institute and I ask for the funds, and in return I told them that I'll teach your kids or your family members or your close friends. You can send 10 students after a year. Do investment right now. Do investment in my company right now. And in next 2 years, you can send 20 students free of cost. I'll teach free of cost, right? So it's like reward-based. Now, this involves promising specific items rewards to contributors before the launch of a new project, product, or business. A reward-based campaign is not generally targeted at contributors who are looking to profit from their investment, but at those who want to own a new product, right? So they will be getting the product itself, right? So in these cases, we sometimes books revenue, but again, this is the issue that right now we have received the funds, but we have not provided anything to them. Right now, look at me very carefully. Right now we have received the funds, but we have not provided any goods or services, but we promised to provide goods or services in the future. We promise to provide goods or services in the future. So in that case, you book deferred income. Or according to the new IFRS 15, we use the word contract liability. We use the word contract liability, right? Now, donation-based crowdfunding. Contributors make donations to a project or company and may receive existing rewards. Yes, you give something your existing product. So in this case, you book revenue immediately. In this case, you don't have any obligation to transfer. We don't have any obligation to transfer anything to them in future. We don't have any obligation to transfer anything in future. So yes, it's your revenue. Some forms of donation-based crowdfunding don't involve any sort of reward, as donors wish to contribute for a particular cause. Yes, take it. So it's our benefit. It's our benefit, right? So these are the different types of crowdfunding. These are the different types of crowdfunding, right? Now, read this. This is the general paragraph. Obviously, if you are treating it as equity or loan, then you go for financial instrument. If you are treating it as equity or loan, then definitely you will go for financial instrument, because that area is covered by financial instrument. But if you are treating it as revenue, if you are treating it as revenue, then you have to go to IFRS 15. Then you have to go for IFRS 15. Then you have to go for IFRS 15. Now look, now again, there is an issue with IFRS 15. You know, there are 5 stages. Listen to me, students. There are 5 stages. There are 5 stages. There are 5 stages. Number 1, listen, look at here. 5 stages in IFRS 15. The last stage is book revenue. The last stage is book revenue. So there are 2 points how to book revenue. The first is point in time, and the second is over time. So you need to check which method you should use, the point in time or over time according to the situation. Point in time and over time according to the situation. Please have a look. Have a look. If the crowdfunding campaigns involve the issuing of rewards, then IFRS 15 should be used to determine when to recognize revenue. For each performance obligation, the company will need to determine whether the performance obligation is satisfied over time, that is control of the goods or services to transfer over time. If one or more of the criteria in IFRS 15 are met, then the company recognizes revenue. Yes. If none of the criteria is met, then control transfer to the customer at a point in time. Now wait. Hope you remember whenever you studied IFRS 15, in the last stage you discuss overtime and point in time. In overtime, you find 3 conditions. In overtime you find 3 conditions, and out of these 3 conditions you have to meet any one, then you can book overtime revenue. But for instance, if none of the 3 conditions is met, if none of the 3 conditions has met, then you go for point in time. But for point in time, definitely the control must be transferred. The control must be transferred. The control must be transferred. The control must be transferred, right? Now, here there is a question, very interesting question, very different one. If you have already read the articles or you have solved the kit, then you can do it. Even this is linked to little bit F7 FR level. Do you know when the outcome of the contract is uncertain? Anybody knows when the outcome of the contract is uncertain, what treatment we do apply? Please write on the chat box. Please, let's communicate. Tell me, let me tell you, when the outcome of the contract is uncertain, then you can only book revenue to the extent of the cost incurred, which is recoverable. I repeat, when it's about IFRS 15 and very famous dialogue. When the outcome of the contract is uncertain, then you can book revenue to the extent the cost you have incurred, and that cost is also recoverable. Then you can book the revenue to the extent of the cost, so automatically the profit will be 0. Just think, if you have incurred cost of 100 rupees So you can book the revenue of 100 rupees as well. That's it. So automatically the profit will be zero. Profit will be zero, right? But in this case, you can only book this revenue if this cost is recoverable. If this cost is recoverable, right? Okay. Now, keeping this in mind, let's read this paragraph. Let's read this paragraph. Okay, be active now. On 1st September X9, Burnett Company decided to undertake a crowdfunding campaign to finance the production of a new racing bike. See, they are launching a new racing bike. This is their product. Okay. The Kraken. They made a short film with famous cyclists which set out the qualities of the Kraken bike and posted it on the Paddle Starter crowdfunding platform. Okay. This is a platform which will generate them the amount, right? So they use this platform, but this platform is not free. Now, the campaign raised $4 million. Now, that means initially they receive bank debit 4 million. They receive 4 million. Okay. On which Paddle Starter charged 7% commission. Come on, calculate. 4 million times 7% is how much? $4 million times 7% is 280,000. 4 million times 7% is 280,000, right? Okay. Now listen. 4 million times 7% is 280,000. So this is your first cost. Don't forget, commission is your first cost. Okay. Now, the contributors of the crowdfunding campaign were promised. See what we are giving in return. Were promised a reward of 1 Kraken bike for every $4,000 contributed. Now wait, we receive $4 million, and for each $4,000 we will give 1 bike, 1 Kraken bike. Tell me how many bikes we have to give. How many bikes? Come on, you guys are no more kids. Quickly tell me how many bikes we have to give. Very good. 1,000 bikes. How? We generated 4 million and divided by 4,000. 4 million divided by 4,000. This is 1,000 bikes. This is 1,000 bikes. Okay. 4 million divided by 4,000. This is 1,000 bikes, right? So we have, now that means we receive this 4 million. In return, we have to give 1,000 bikes. Now, first, easy thing. These points you can score. See, these are the easy points. Have you delivered these bikes right now? No. No. So definitely initial entry will be deferred income. Or contract liability. Initially, the transaction is a contract liability. Initially on the day one. When you receive the funds, it's a contract liability. Okay. Now look at here. At the financial year end of 31st December X9, Burnett Company had manufactured only 50 Kraken bikes at a total cost of 240,000. But none had been delivered to contributors. Okay, no issue. There was some doubt. See, this is the real turning point. There was some doubts as to the capability of the company to develop, manufacture, and deliver the bikes promised. But see, this is the case. See, this point clearly says that the outcome of this contract is uncertain. The outcome of the contract is uncertain. So I told you these are the wordings. If you guys can go and check in your book, check in your exam kit, these lines are written. When there is uncertainty of the outcome, then you can only book. Look at me. You can only book revenue to the extent of cost incurred, provided that cost is recoverable. Okay. Now, but Burnett Company is sure but Burnett company is sure that the funding will cover any cost incurred. Yes, whatever cost you have incurred, you will recover it. So in this case, you can book revenue to the extent of cost incurred, to the extent of cost incurred. Now, my dear student, my dear active students, come on, quickly tell me how much cost we have already incurred. How much? Which guy? Which student can tell me how much cost we have already incurred? 240,000, and other one is, there is one more cost. There is one more cost. 280, 240K and 280K, 240 and 280, 240 and 280. Yes. So we have incurred 520K. We have incurred 520K, and this cost is recoverable. So you can book revenue to the extent of 520. You can book revenue to the extent of 520K. You can book revenue to the extent of 520K, right? Yes. Now tell me, how much initially you received? All of you, please tell me. 4 million. 4 million you received, and out of 4 million, 520,000 will be transferred in the revenue account. Out of this 4 million, 520,000 will be transferred in the revenue account, and remaining amount is deferred income. Remaining amount is still deferred income. Is how much? 3480000. 80. 3480000, I think. How much? Is this the right amount? 3480000 in the deferred income account. Now just giving you 1 minute to read it. 1 minute to read it, and then I'll show you the examiner comments on it. Examiner comments on it. Okay, read it, please. Check it, please. Check it. Take your time, just quick walk through it. Take your time, Okay, you can see this. Now, in the same article, if you read the same article, you will find some sort of revision of impairment of financial instrument. When you guys were doing IS 36, your teacher taught you that there are certain areas on which you can't apply IS 36. There are certain areas on which you can't apply IAS 36, IAS 36, right? And one area is financial instrument. On financial instrument, there are separate rules. On financial instrument, on financial assets, there are separate rules. Okay, right? And one thing in financial assets, for financial assets, hope you remember, there is one is debt market, one is equity market. When you talk about financial asset, yes, you can invest in equity market and you can invest in debt market. In equity market, there are two categories: fair value through P&L and fair value through OCI. There are no impairment rules for equity market. There are no impairment rules for equity market straight away. But yes, in debt market, if you invested in a debt instrument, that means if you have given loan to somebody, in that case, there are total 3 categories. One is amortized cost, one is fair value through OCI, and one category is fair value through PNL. Okay, in debt market there are 3 categories. Now the question is this impairment accounting, where we are going to apply this impairment accounting. We can apply impairment accounting for amortized cost. Look at here, for amortized cost investments and fair value through OCI investments. Okay, don't forget this. We can apply this impairment accounting on amortized cost investment and fair value through OCI investment. I'm sure you all must know these things. Now, and you all better know this, previously when IAS 39 was there, there was one model, incurred loss model. And now the latest model is expected loss model. Previously in this world there was incurred loss model. Now in this current world we have expected loss model. Incurred loss model is like bad debts written off. In incurred loss model, they normally wait for objective evidence. But in expected loss model, you don't wait for objective evidence. Or in very simple words, whenever I teach this topic, I teach with comparison of your basic accounting. When you guys were doing high school, when you guys were doing O levels, A levels, when you guys were doing F3, FA level exams, remember you used to do a bad debts chapter. The practical accounting of this topic is almost like bad debts chapter. So previously incurred loss model was like bad debts written off. And now this expected loss model is like allowance for doubtful debts, provision for doubtful debts, or allowance for doubtful debts, right? Okay. So in incurred loss model, the entry should be bad debt debit, and you simply credit the receivable. Right? But in expected loss model nowadays, you make the entry expense debit and allowance. Expense debit and allowance for receivable. Expense debit and allowance for receivable credit according to the stages. You do this. Okay. So now, just the impairment model of IFRS 9 introduces 3 stages. These are the 3 stages. Let me summarize you. Stage 1. Normally we are at stage 1 when there is a very low risk, when there is a low credit risk, right? So in that case, you just see this word, you just book 12 months ECL, expected credit loss, are recognized, which means that entity has to calculate the expected losses in the next 12 months, taking into account the risk of default. Now, what does it mean? Listen, we use the word for stage 1. Look at here. We book only next 12 months expected credit loss. What does it mean? It means if default occurs in next 12 months. So whatever loss we will face for the whole life, we have to book. For example, if in the next 12 months our debtor goes bankrupt, so because of that bankruptcy or because of that problem, whatever loss he will give us, we have to book it, multiply by the probability of default, PD, okay? So this next 12 months does not mean that whatever funds he will not give in next 12 months. No, 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 no. This is not the meaning of next 12 months. Next 12 months means if, listen it again. If that party, the other party defaults in next 12 months, so whatever loss he gives us because of that default throughout, we'll calculate the present value. We'll calculate the present value of that default, and we'll multiply that present value with the probability of default, PD. This is the meaning of next 12 months. Okay. Now stage 2. Stage 2 deals with the financial instrument that have a high increase in credit risk. But again, listen, there is no objective evidence. You know what do you mean by objective evidence? Objective evidence means my debtor called me and he said, no, sir, I can't pay you now. This is the objective evidence. My debtor called me and he says, please give me some concession. Please, I can't, I'm getting bankrupt. Or his lawyer called me. So these are objective evidences. So in stage 2, again, you don't have, objective evidence. Although that party risk is very high, the credit risk is high, but again, you don't have objective evidence. So again, this time you'll make the entry of allowance. So in the stage 1, the entry, the entry is P&L debit, allowance for receivable credit. Same entry here. Same entry, you'll multiply P&L debit and allowance for receivable credit. Okay. But yes, the expected losses over the life. Now you are not going to book next 12 months, only next 12 months. Now you are not going to book only next 12 months, but for the whole life. Now you are going to see the picture of O for the whole life, right? Stage 3. This stage 3 is the old model. This stage 3 is the incurred loss model. This is basically incurred loss model. Now you have objective evidence. Always listen this. Even if you read your study text, even if you solve, test your there are some test your understanding in the study text. If you see of financial instrument, you will find this thing, and the identification of stage 3 is objective evidence. Now the lawyer called you, the opposite guy called you that I can't pay, or that's the issue. So there is objective evidence. So now you have to make the entry bad debt debit, expense debit, and you will simply credit the receivable. So now the carrying value of receivable will change. In the first 2 stages, the carrying value of receivable won't change, but in the stage 3, you will simply change the carrying value of receivable. Okay. And once you change the carrying value of receivable, so your future revenues, your future interest income will be calculated on the revised. Your future interest income will be based on revised carrying value of your receivable. But in the first 2 cases, you will still be booking. In the first 2 cases, you will be still be booking interest income on the basis of gross amount, on the basis of gross receivable, on the basis of gross financial asset. That's the difference. See this. Interest revenue is calculated the carrying amount less the ECL allowance. Now let's do this thing. With numbers. This question is given in the article by examiner. Okay. So please be active and you will understand. If you know a little bit about this. On 1st January X6, see, this is the beginning date. This is the beginning date of this story. Lunar Company granted Skyzer Company a $5 million secured loan, repayable on 31st December X9. Okay. So X6, 7, 8, and 9, 4 years loan with an interest rate of at the reporting date. Okay. 3% payable annually at the reporting date. Now, they have covered 3 years. Listen, you go with first column, then second column, and then third column. And in the first year, they discuss stage 1. The first year is 2006. Just think about it. 1st January X6 to December X6. This is your 2006. In 2006, your examiner discussed the stage 1. In 2007, they discussed stage 2. And in 2008, they discuss stage 3. Okay. They will communicate pure, right? Now, first of all, this is the stage 1, the first year. Just read this column. My dear student, just look at here. This column is right now relevant. On 31st December X6, there has been an increase. There has been no increase. See, no increase. That means low credit risk. There has been no increase in credit risk, and the probability of default in the next 12 months is 5%. See, I told you, in the stage 1, they will always give you, in the stage 1 accounting, they will always give you probability of default. Now, the present value of the cash shortfalls expected over the life of the instrument, if the default occurs in the next 12 months, is 200,000. Exactly the same wording they are using, which I told you. You are not getting. Stage 1 means, listen, in stage 1, when we use the word next 12 months, it means if that guy defaults in next 12 months, if that receivable defaults in next 12 months, so whatever amount he won't pay us throughout the whole life, we have to consider the present value of that amount. Okay. See this, see the words. The present value of the cash shortfalls expected over life of the instrument if the default occurs in next 12 months is 200,000. So now, how to calculate the allowance? I told you, the present value of these losses multiplied by the probability of default. Simple method. Present value of these losses multiplied by the probability of default. So here you go. 200,000 times the 5%. How much is this? 200,000 times the 5%. How much? Please tell me. It's 10,000. 200,000 times 5% is 10,000. 200,000 times 5% is how much? 10,000. So now this is stage 1. Can anybody tell me what is the double entry for stage 1? Stage 1 is pure allowance. Stage 1 is not written off. It's pure allowance. What is the double entry? Tell me, please. Write on the chat box. P&L debit and allowance for receivable credit. Allowance credit. This will be the entry. Entry will be, let me write here on the top. So this is the entry. This is the entry for first year. And now just think, December X6 is gone. Just one more question from you. How much interest income we'll book? We'll simply book 3% of 5 lakh. We will be simply booking 3% of 5 million. 3% of 5 million will go in the P&L, because allowance accounting is a separate accounting. Your gross receivable will remain same. Your gross receivable will remain same, and your interest income, your interest revenue will be calculated on gross receivable. Okay. This is for stage 1 and stage 2 as well. Now, one more thing. If you guys have done basic accounting in your life, if you have done the basic accounting, you remember the allowance accounting when you were kids, that in future periods, you just have to put increase or decrease in allowance in the P&L. Remember this thing when you were kids in your high school, O levels, A levels. Increase in allowance is treated as an expense, and decrease in allowance is treated as an income. Increase in allowance is treated as an expense, and decrease in allowance as an income. So for future periods, keep this thing in mind. For future period, keep this thing in your mind, increase or decrease in allowance. Okay. So now with this thing, read the second year. But yes, at the end of the first year, how much is your allowance? All of you, please tell me. At the end of the first year, how much is your total allowance? 10,000. At the end of year 1, how much is your total allowance? It's 10,000. So that means at the beginning of year 2, the opening balance of allowance is already 10,000. Okay. At the beginning of year 2, the total balance of allowance is 10,000. Don't forget this. Okay. So because now you have to do the increase or decrease game. Now, my respected students, watch stage second column. Now stage 2. Stage 2. On 31st December X7, the credit risk of the loan increased significantly. Yes, increased significantly, but nothing is written. Nothing is written that we have objective evidence. We have objective evidence, and there is one more word they use, credit impaired. They use the word credit impaired. If they use the word credit impaired, that also means objective evidence. So this is a stage 2. Yes, we have high risk. We have high risk, but no more objective evidence. So still we are on stage 2. Now read. The probability of default occurring over the remaining life of the loan is 45%. Now PD is 45%. The present value of ECL from default events over the life of the loan are expected to be 400,000. So now, first of all,